This is Andrew's Thoughts, and we're looking at Uncovered Asia. I'm looking at the companies in Asia that analysts aren't covering. Today, I was just recently looking at this company, China Shengmu Organic Milk. And my question to you is Chinese demand for organic milk going to keep up with a 270% price rally? So let's look at the company. It's China's largest organic dairy producer, and it's listed on the Hong Kong Stock Exchange. And it's the only vertically integrated organic dairy company in China that meets EU organic standards. That's pretty rare. There's two segments, raw milk and liquid milk. Let's look at the raw milk section. And that's the segment where they breed dairy cows and distribute raw milk nationwide. They have 13 organic dairy farms, and there's 6 more that they've recently purchased from the exercise, I believe, of warrants. They have over 40,000 cows, and this segment makes up 90% of revenue. The other part is the liquid milk segment, which they produce and distribute organic milk and yogurt, though it's a much smaller part. So here we can see the price starting to shoot to the moon. We've had a 270% price rally in the past 3 months. Part of that's due to the rise in milk prices, but also the expansion into the new farms. Of course, volatility is extremely high also. So let's look at this company using the tool I developed called Worldclass benchmarking. This tool helps identify a company's competitive position relative to global peers. And the combined composite rank of profitability and growth is something I call profitable growth. It considers a company over 5 years, and the past 12 months are a rolling 12-month average of the latest quarterly results. I rank companies on a scale from 1 being best to 10 being worst. And here you can see that profitable growth is average relative to 490 consumer staples companies worldwide. So it hasn't knocked it out of the park relative to global peers. Now, if we break down profitable growth into profitability and growth, we can see that profitability is above average, but EPS growth is where the challenge is for the company right now. And also, if we look at profitability, one part of profitability is asset efficiency, and that's the big challenge for the company. How do you get more assets out of the land-intensive business that they have? But they have to be land intensive because they try to be organic. And here you can also see that the milk price shot up, and this went up from roughly $17.50 up to about almost $24, and now it's come back down. So that's part of what drove the earnings. That's probably less likely to be repeated. Now, let's now look at the stock's attractiveness by using my FVMR scorecard. It's a scorecard that I developed that considers a stock investment's attractiveness relative to stocks in that country or region. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. So this tool lets us look at all 4 of them rather than just focusing on one of them. It considers a company also over 5 years, and the past 12 months are a rolling 12-month average of the latest quarterly results. It's a scale from 1 best to 10 worst. So here you can see the fundamentals in the upper left-hand corner. High ROE, pretty good, and has been improving, and it's driven by a strong net profit margin. And valuation is cheap compared to other Chinese companies. Notice at the bottom left that I'm comparing this against 2,769 financial companies in China. And this is how I look at any company, which is relative to its country peers. Then we have momentum. It's definitely got a high price momentum, and so we're seeing that. But there's also high earnings growth, revenue growth momentum. And finally, risk is best relative to peers. This is driven mainly by the fact that the beta, meaning price risk, is very low relative to the market. The company has taken on debt, particularly to expand its farms, but you can also see that debt went down in the past 12 months because of the fact that they raised capital through the warrant issues. When you look at times interest earned, it's at 3.5 times. So definitely that rise in debt is putting some pressure there. But the beta relative to price volatility is overriding some of that on the fundamentals. So what's the growth opportunities? Well, China is one of the fastest growing markets for organic dairy. Dairy production has grown over 2,000% since 1980. The price of milk has been rising post-COVID. And there's, of course, rapid urbanization in China and higher disposable incomes from people's increased desire to consume organic, pest-free produce. I know myself in China that there was a period of time where Chinese people felt like they couldn't trust the supply chain there. But this company seems to be delivering on that. So the question is, can this company, can the Chinese demand keep up with a 270% price rally? My question to you. Leave a comment below.